Okay, moving on. Cash provided from operating activities using the indirect method. I really don't like I really don't like the slides so much. So for a little bit, I'm at least gonna do it my own way. Okay? So cash provided from operations using the indirect method. We are going to start with net income. Okay. So net income is our starting point. And I'm just going to make something up. I'm just going to say that our net income was 50,000. Then I am going to add depreciation expense. And I'm just going to make it up. Let's assume my depreciation expense was 10,000 on the income statement. So I would just add that. Then I am going to add a loss on disposal of an asset. And I'm just going to assume we had no loss. And I will subtract a gain on disposal of an asset. Then, and again, I'm going to just assume there's no. Then I am going to add decreases in current assets, right? So accounts receivable, inventory, supplies. So if I have a decrease from one year to the next, I would treat that as a source of cash. Okay. I am going to subtract increases in current assets. So if one year to the next, I have an increase in current assets, that is going to be like a use of cash. And I'll get into why in a minute. I am going to add increases in current liabilities, and then I will subtract decreases in current liabilities. All of that will give me cash provided from operations. And I kind of ran out of room here. Cash provided from operations using the indirect method. Okay, so let's talk about, and again, what I have here is the formula. Okay, so what we can do is we can sort of think, let's just use the formula. We cannot understand a single thing that's going on, but as long as I know the formula, I might be okay. Let's spend a little bit of time thinking about what's happening. Okay, if I think about my income statement, I have revenue 100,000, and then I could have cost of goods sold 20,000 for gross profit of 80. Then I can have depreciation expense of 10,000 for net income of 70. Okay. Here's the deal. Sorry. I messed it up. 100 minus 40, bear with me, gives me 60. Then I have depreciation of 10,000, which gives me net income of 50. All right, this I messed up, so ignore that. It's the nice thing about being a teacher. When you fuck up, you could just scribble out your mistakes. Okay, so $50,000 is my net income. Okay, and what I'm trying to do is figure out how much cash did I generate from this $50,000 in net income. So using the indirect method, I'm going to start with my net income. And then the first step, I'm going to add depreciation. And if we think about depreciation, that is a non-cash expense. Remember, we're not spending $10,000 to pay for depreciation. We've already purchased the asset and we're just recognizing the asset's decline in value in this period. And that is a non-cash transaction. So if I'm trying to figure out how much cash I generated from running my business, I'm going to add back depreciation. Also add back amortization, and I'll also add back impairments, right? But we are adding non-cash transactions back to income because there was no subtraction from income, at least no cash subtraction. So over here, right, the real income, cash income, I should say, I really earned 60,000 in cash because this $10,000 deduction was a non-cash transaction. And remember, I'm trying to reconcile cash from running my business. All right, so that's definitely step one. Okay, I'm gonna go on. I erased some stuff just so that we make things easier to follow. Okay, disposal of an asset. All right, so any of the cash that we receive or that, well, let me back up. Yeah, any cash that we receive from the sale of an asset long-term asset should be recognized in the investing section. However, the gain or loss associated with that sale shows up on the income statement. And so what we're doing is we want to remove any of the gain that we recognized from the income statement because the cash provided from operations only includes things that relate to our day-to-day business. So we want to remove this from the income statement so that we can properly recognize it in the investing section of the cash flow statement, right? So if I have a loss on the disposal of an asset, a loss is going to lower my income. So if I want to remove that from the income statement, I'm going to add that back to income. And then likewise, if I have a gain from the sale of an asset, that is going to increase my income. So if I want to remove that from my income statement, I would subtract it from income. Okay. So that is these two right here. We are just simply, for now, I would certainly just follow the formula. Okay. But we want to take it out of the income statement, and then we'll show those transactions in the cash provided from investing section in the next section of this cash flow statement. Okay, so let's get back to trying to think through what's happening. So the next thing is we have decreases in current assets, okay? And I can think about accounts receivable as something fairly straightforward. So let's say that in 2024, I have accounts receivable of $10,000. And in 2023, I had accounts receivable of 16,000. The change is a decrease of 6,000, right? From 2023 to 2024. In 2024, my accounts receivable went down. And so if we think about what's happening, the only way that accounts receivable is going to go down, not the only way, but the primary way, has to do with customers paying us money they owe us, right? So if I'm lowering my accounts receivable, it means that I'm increasing cash, right? So I would treat a $6,000 decrease in accounts receivable as an increase to cash, right? So it would be a positive 6,000. Inventory would be the same thing. I could have inventory of 10,000 in 2024, and I can have 16,000 in inventory the previous year. If my inventory goes down, all else equal, it means that I converted it to cash or I sold it. Okay? So the opposite is true. An increase to a current asset is a use of cash, right? So maybe we could talk about supplies. Supplies is a current asset. Let's say I have supplies of 5,000 in 2024, and I had no supplies in 2023. The change is a $5,000 increase in supplies. Supplies is a current asset, right? So if my supplies went up, all else equal, it probably means I used cash to acquire supplies. So I would treat an increase to current assets as 5,000 decrease. We can also think about, we can go back and talk about accounts receivable. Maybe I had 65,000 in accounts receivable the previous year. Sorry, this year, I apologize. And I had 60,000 in accounts receivable last year. So it would be an increase of 5,000. My accounts receivable went up from 60, that is a zero. It went up from 60 to 65. If I made sales and customers didn't pay me, my accounts receivable goes up. So I'm saying that some portion of my income is derived from sales that I made that didn't involve cash. And so if my accounts receivable goes up, it means that I didn't collect cash, and therefore I should subtract it from current assets. Okay, I can erase the current assets and we can start talking about current liabilities, right? The first one that we could talk about would be accounts payable, right? Again, I can have 2023. And let's talk about accounts payable, right? Let's say that in 2024, my accounts payable was 75,000. And in 2023, my accounts payable was 60,000, right? I have clearly a change in accounts receivable. My accounts payable, that clearly went up by 15,000. And think about it. I'm acquiring something. So if I'm selling t-shirts and I acquired a bunch of t-shirts and I acquired them on account, that's sort of like a source of cash. Credit is a source of cash. So a 15,000 increase in accounts payable would be a $15,000 increase in cash. And then likewise, if I have salaries payable, maybe I had salaries payable of 5,000 in 2023 and nothing in 2024. And therefore the change is a negative 5,000. Well, if my salaries payable went down, it must be that I used cash to pay my employees, right? So a 5,000 decrease in salaries payable is going to be like a use of cash. All right. That's the formula. I don't know why they do it, but they show the formula like in the very last slide of this section. I'm not totally huge on that, right? And again, here, this is slide 26. So again, we're starting with net income, and then we would add non-cash expenses, right? So depreciation, depletion, amortization, right? And then we would also add back losses on the disposal of an asset. And then we are going to subtract, right, any non-cash gain or any non-cash revenues. The most common, if ever, is the gain on the disposal of a long-term asset. Okay. And then here is what we were just talking about. A decrease in non-cash current operating assets, right? Again, it's current assets, is going to be a positive to cash flow. If my current assets goes down, it means that it's an increase to cash. Sorry, an increase in my accounts receivable would be a decrease to cash. Anyway, that is the formula. So in our example, right, here is my income statement. I'm going to start with the income statement, and I'm starting with 38,000. Okay. So 38,000 in income, that's going to be my starting point. Here is my depreciation in my income statement. So I would add depreciation, 24,000. And then it doesn't look like oh, here we go. Loss on the sale of plant assets, gain on the retirement of notes. Funny, funny, funny. Okay, so if I have a loss, remember, I am going to add that back. And then if I have a gain, I am going to take that out. Right? And we can go back to this. This is I'm going to add back depreciation. I'm going to add losses, and I'm going to subtract gains. I would definitely not memorize, but have this formula with you while you're tackling this chapter. Okay, then we can go back. Now I want to go to all of my current assets, and then I'll deal with my current liabilities. So cash I'm not worried about. All right. Just wanted to point out, this is our cash provided from operations. And we started with net income, and then we just went through and we added back our depreciation. We added back the loss on plant assets, and then we subtracted the gain on our retirement of our note. So going back, and this is what we were doing over here. And so what I want to do now is move on to the current assets section. And again, I want to look at the balance sheet. I'm looking at 2021 compared to 2020. I'm not going to deal with cash again, right? So cash is what we're trying to reconcile. So we don't really worry about changes in cash. That's what we're calculating. But we want to start with accounts receivable. Accounts receivable is a current asset. And we had 40,000 in accounts receivable in 2020, and then it jumped up to 60,000 in 2021. And if we go back to our notes, we were saying that an increase in a current asset is like a use of cash, okay? So we would subtract our $20,000 increase in accounts receivable. And it makes sense. We had $20,000 worth of sales that were made on account, and therefore we didn't get cash. So we need to, unfortunately, subtract those from our net income because we never received the cash. So if I go to my cash flow statement, at least the section that I'm dealing with cash provided from operations, we're subtracting the 20,000. Okay. Then I'm going to jump down to inventory. Inventory also went up by 14,000, and therefore that is again a decrease to cash, right? The only way that my inventory goes up is if I use cash, all else equal. And then we have prepaid expenses. Those went up. So again, that is another use of cash. So all of my current assets went up, and so we are subtracting those from cash. Then we can go down to so again, we're not dealing with long-term assets because that's the investing section. So I'm now going to jump down to my current liabilities. I have accounts payable was 40,000 in 2020, and then it's 35,000 in 2021. So if my accounts payable goes down, it must be that I used cash. So a decrease in accounts payable is a decrease in cash. So here again, we are subtracting my decrease in a current liability. Next one, interest payable. Interest payable also went down. So there is another use of cash. And then income taxes payable, that actually went up. We owed 12,000 and then now we owe 22,000. So that actually went up. And so we would treat that as a source of cash, right? And so we treat the increase in income taxes payable as a source of cash, and then we just treated the decrease in interest payable of 1,000 as a decrease in cash. So we have 38,000 net income that generated 20,000 in cash. And that is cash provided from operations using the indirect method.